Hello, this is Vietnam's Hidden Voices. Let's begin the real story of Vietnam. Vietnam's middle class is passionate about buying apartments, but when it comes to the stock market, they remain surprisingly hesitant. Today, let's talk about the main structural reasons behind this hesitation. Vietnam's stock market is growing quickly, but it is still unstable in terms of transparency, governance, and information quality. Corporate governance is often unclear. Financial statements can be unreliable, and the market reacts strongly to rumors. This is not unique to Vietnam. Korea also has similar issues. For example, when LG Chem spun off its battery business into LG Energy Solution, minority shareholders suffered losses. This raised serious concerns about governance and shareholder rights. Vietnam faces similar risks. When Vinhomes was listed, even though its parent company Vingroup was already listed, many investors question the transparency of capital flows inside the group. Because of this environment, the middle class does not see the stock market as a transparent or predictable place. In Vietnam, bank deposits offer high guaranteed returns. Commercial banks often pay between 4 and 6%. Online banks sometimes pay 6 to 8%. So the decision becomes simple for the middle class: a guaranteed 8% or a risky stock. Naturally, most people choose safety. Financial literacy in Vietnam is still developing. Concepts like long-term investing, diversification, or professional asset management services are not yet widespread. Because of this, people tend to stick to what they know. And what they know best are deposits and real estate. Another major factor is Vietnam's underdeveloped pension system. In countries like Korea, the United States, and most of Europe, national pension funds, corporate retirement plans, and personal pension accounts continuously supply long-term capital to the stock market. These flows keep the market stable and encourage long-term investing. Vietnam, however, has a very different structure. The national pension system is limited. Corporate retirement plans barely exist, and the private pension market is still in its early stage. As a result, Vietnam's stock market receives very little long-term and stable capital. This leaves the market dominated by short-term trading, which naturally feels volatile and unpredictable to ordinary people. During the last decade, apartment prices in Hanoi and Ho Chi Minh City rose steadily. Almost everyone knows someone who made money from property. In contrast, stories of people losing money in stocks are much more common. Because of this, real estate is seen as a safe asset, while stocks feel risky. If information about local companies seems limited, or if governance risk worries you, then the most realistic and safest method is to use index tracking, ETFs. If you live in Vietnam, you can access the VN30 ETF, which follows the top 30 large-cap companies on the Ho Chi Minh Stock Exchange. You can also use the VN Diamond ETF, which includes high-quality companies where foreign ownership limits are almost full. If you live outside Vietnam, there are still options. In Korea, you can use the AC Vietnam VN30 ETF. In the United States, you can use the VNM ETF. In short, if individual stock analysis feels difficult, investing through an ETF that you can access from your country is the simplest and most practical way to participate in Vietnam's economic growth. Today, we explored the structural reasons why Vietnam's middle class still avoids stock investing. As Vietnam's financial system matures, the balance between real estate, deposits, and equities will naturally shift. And understanding this transition is the key to navigating Vietnam's next decade. Thank you for watching.